The 1990s were the age of corporate giants. Technology, energy, and global finance seemed unstoppable. Among these titans, none appeared more innovative than Enron, the Houston-based energy company hailed as one of America's most admired corporations. Fortune magazine named it America's most innovative company, 6 years in a row. Investors, analysts, and politicians alike praised its brilliance. But in late 2001, Enron collapsed into bankruptcy in one of the most shocking corporate scandals in history. Tens of thousands lost their jobs, investors lost billions, and the name Enron became synonymous with fraud. Wall Street was shaken, regulators scrambled to act, and the episode remains a cautionary tale of greed and deception. Enron began as a traditional pipeline business, but reinvented itself as an energy trading powerhouse. It pioneered markets where electricity, natural gas, and even broadband capacity could be traded like stocks. CEO Jeffrey Skilling and Chairman Kenneth Lay sold investors a vision of the new economy, where Enron was less a utility and more a high-tech financial institution. The company reported soaring revenues, but beneath the surface, its success was built on deception. Enron used complex accounting tricks, called special-purpose entities, to hide debt off its balance sheet. Loss-making projects were concealed, while profits were inflated. Executives pressured employees to maintain the illusion, and Wall Street analysts were dazzled by what they thought was financial wizardry. The culture at Enron encouraged risk-taking at any cost. Traders pushed deals regardless of profitability, driven by huge bonuses tied to short-term gains. Employees were urged to rank and yank, a brutal system where the lowest performers were fired each year. The corporate image was glamorous, but inside it was toxic. By 2001, cracks began to show. Investigative reporters and skeptical analysts noticed that Enron's financial statements were opaque. In October, the company admitted to overstating profits by nearly $600 million. Credit rating agencies downgraded its debt, triggering a collapse in confidence. Enron's stock, once trading above $90, plunged to less than $1. In December 2001, Enron filed for bankruptcy, the largest in U.S. history at that time. Employees saw their retirement accounts, heavily invested in Enron stock, wiped out. Wall Street firms that had enabled the company's rise faced lawsuits and reputational damage. The fallout spread far beyond Houston. Accounting firm Arthur Andersen, one of the world's largest, was found complicit in shredding documents to cover up Enron's fraud. Andersen collapsed, throwing tens of thousands out of work. Regulators faced enormous pressure to restore confidence in corporate America. The result was the Sarbanes-Oxley Act of 2002, a sweeping reform that required stricter financial disclosures, harsher penalties for fraud, and greater accountability for executives. For Wall Street, it was a clear signal. The age of unchecked corporate accounting tricks was over. The Enron scandal remains a defining moment in financial history. It revealed the dangers of blind faith in corporate leaders, the failures of auditors and analysts, and the devastating impact of unchecked greed. For Wall Street, it was a harsh reminder that markets depend on trust, and when trust is broken, collapse follows.